I need you to stop refreshing that price chart right now. I need you to stop screaming into your pillow. And I absolutely need you to stop texting your spouse, telling them you have to liquidate everything to cover a margin call. The margin call isn't real. Your position is safe. But the chart you're staring at, that's not safe. That's a crime scene. Mark here from GoFinance. And if you woke up this morning seeing red, if you're watching silver get obliterated below $90 and gold taking a nosedive and you're feeling pure fear right now, then I have news for you that's going to change everything. You've fallen for the trap. You're watching the puppet show while the theater burns down behind you. Because while the price on your screen says crash, the data coming out of the vaults says bank run. It is Friday, January 30th, 2026. End of the month, end of the week. And the powers controlling this market decided to throw a party. They invited the price of silver to what can only be described as a red wedding. They took it out back and clubbed it like it owed them money, from over $120 to under $90 in 24 hours. To someone who doesn't understand how this game works, this looks like the apocalypse. It looks like the bubble popped. It looks like everyone who said precious metals were going to the moon was wrong, and you should have listened to Jim Cramer and bought index funds. But if you wipe the panic from your eyes and actually look at the ledger, if you examine the delivery notices that were issued this morning, you will see something that defies all logic. You will see proof that this price crash is not a sell-off. It's a desperate failing attempt to stop a nuclear explosion in the physical market. Today, we need to talk about first notice day. And if you don't trade futures, let me explain exactly what this means. Because understanding this single mechanism is the difference between panicking and profiting. First notice day is the day of reckoning. It's the day where everyone holding a futures contract has to make a choice. Choice A, you roll your position. You sell the February contract and buy the April contract. You kick the can down the road. You stay in the paper game. You never touch physical metal. Choice B, you stand, you do nothing. You let the contract expire. And by doing nothing, you are legally demanding that the exchange deliver you the actual physical metal, the bars, the real stuff. Now, usually when the banks smash the price right before first notice day, they do it for one very specific reason. They want to scare you into choice A. They want you to panic. They want you to look at that red candle and think, oh my God, this thing's going to zero. I better get out now before I lose everything. They want you to roll over. They absolutely do not want you demanding physical delivery. So they paint the tape red. They create the illusion of a sell-off. They manufacture fear. And what happened today? Did the longs run away? Did they panic and roll their contracts forward? Did they choose the paper game? No. They stood their ground. They crossed their arms, looked the banks directly in the eye, and said one thing: I don't care what your screen says. Give me my gold. We have just witnessed delivery volume that can only be described as nuclear. The official data from the CME group was released this morning, and what it shows should terrify anyone who thinks the paper price represents reality. For the February gold contract, which isn't even the biggest contract of the year, we saw 20,484 delivery notices issued on day one. Let me put that number in perspective for you. A standard gold futures contract represents 100 ounces. So grab your calculator. 20,484 contracts times 100 ounces. That's 2,484,000 ounces of gold. That's roughly 63 metric tons. 63 tons of gold that just changed hands in a single instant. It moved from the short, the seller who promised to deliver, to the long, the buyer demanding delivery. And it moved at the exact moment the price was being massacred on the screen. Think about the psychology of that for a second. If the price is crashing, if gold is falling off a cliff, why would you demand delivery of 2.5 million ounces? Why would you catch a falling knife? Why would you take physical possession of an asset that everyone is supposedly dumping? Because you know the knife is fake. You know the price is manipulated. You know that 63 tons of physical gold is worth more than any amount of paper dollars. Regardless of what the ticker says, this is a massive vote of no confidence in the paper system. The entities standing for delivery, the whales, the sovereign wealth funds, the central banks, are effectively saying one thing: we're taking the metal out of the casino, we're removing it from your fractional reserve game, and we're going home. And who's on the other side of this trade? Who's the entity that has to cough up 2.5 million ounces of gold in the middle of what appears to be a shortage? This is where the fingerprints of the cartel become visible all over the crime scene. The biggest issuer of delivery notices, the entity delivering the most gold, is none other than J.P. Morgan Chase. The House of Morgan issued 11,959 notices. That means J.P. Morgan is delivering 1.2 million ounces of gold to the market. They are feeding the beast. They are emptying their vaults to satisfy demand. But wait, there's a twist. Because J.P. Morgan is never just on one side of the trade. They're like an octopus with tentacles everywhere, while their house account was issuing 11,000 notices, delivering gold out of their vaults. Another arm of JP Morgan, likely acting for clients or a different proprietary desk, stopped for delivery. They took delivery of 7,995 contracts. So they gave away 11,000 and took back 8,000. Net result, they bled 3,000 contracts worth of gold. But why the massive churn? Why this enormous volume on both sides? It's a shell game. They're trying to confuse the flow. They're trying to make it look like there's normal market activity, when in reality it's just them moving gold from their left pocket to their right pocket, while frantically trying to fill orders for Deutsche Bank clients and UBS clients who are demanding the real metal. Look at the other players. Deutsche Bank issued 2,387 notices. UBS issued 2,379. The European banks are being drained. The gold is leaving London and Zurich. And where's it going? We don't know the final destination yet, but we know the volume. And we know that normally on first notice day, you might see 2,000 or 3,000 contracts stand for delivery. To see 20,000? That's a 10 standard deviation event. That's a black swan. It means the mechanism of the futures market, which is specifically designed to discourage physical delivery, has failed. The paper price smash was supposed to work. It was supposed to scare people away from taking delivery. It was supposed to clear the open interest and keep the metal in the vaults. It didn't work. The buyers absorbed the smash and demanded the metal anyway. This proves something critical. The price you're seeing on the screen, the price that has you panicked, it's completely disconnected from physical demand. If demand was actually low, nobody would be standing for delivery. If people were genuinely scared of the price drop, they would sell their contracts and run. The fact that 2.5 million ounces stood for delivery while the price collapsed is the ultimate proof of a broken market. It's like walking into a Ferrari dealership, seeing a sign that says Ferrari's 90% off, and watching a line of billionaires waiting to buy them. The 90% off sign isn't a warning, it's a gift. The market is gifting smart money, cheap gold before the system resets. But the gold market, that's just the warm-up act. The real crime, the real trap, is happening in the silver market. Because while gold had nuclear delivery volumes, silver had a nuclear meltdown on the charts. They pushed it from 120 to 90. And just when you thought, I should buy this dip, you realized something terrifying. You couldn't. The buy button was gone. The dealers were offline. The London market was dark. This wasn't a glitch. This was a lockout. Subscribe to this channel if you want analysis that shows you what's happening behind the price. Because what I'm about to show you next is the most sophisticated bear trap I have ever documented. We need to talk about what happened to the price of silver in the last 24 hours. Because if you're only looking at a chart, you're seeing half the story. The other half is what happened when you tried to act on that chart. The price of silver didn't just fall, it was pushed off a cliff. We went from trading comfortably above $120 to smashing below 90 in a vertical red line that would make even a crypto trader vomit. A $30 drop in a single day. A 25% haircut. Now, the mainstream financial media, the CNBCs and Bloombergs of the world, are already writing the obituary. They're running headlines like silver bubble bursts and retail traders wiped out. They want you to believe this is a natural market event. They want you to believe thousands of investors suddenly woke up this morning and collectively decided, you know what? I hate making money. I think I'll sell my silver for $30, less than it was worth yesterday. That's absurd. This was not a sell-off. This was window dressing. And it was executed with military precision. Look at the calendar. Today is January 30th, the last trading day of the month. Why does that matter? Because the bullion banks, JP Morgan, Citibank, HSBC, have to report their books to regulators at the end of the month. They have to mark their positions to market. If silver closes the month at $120, those banks are sitting on billions of dollars of unrealized losses on their short positions. Their capital requirements go through the roof. Their risk managers start screaming. Regulators start asking uncomfortable questions. But if they can smash the price down to $90, even for just one day, even just for the closing bell, their books look magical. The losses disappear on paper. The capital ratios look healthy. The regulators smile and sign off. They didn't smash the price because the fundamental value of silver changed overnight. They smashed it because they needed to paint a pretty picture for the auditors. But here's the smoking gun. Here's the evidence that this wasn't just paper manipulation, but a coordinated physical lockout designed to prevent you from capitalizing on the crash. When the price hit $90, every rational investor on the planet had the same thought. Buy the dip. If you like silver at 120, you have to love it at 90. It's the sale of the century. So you picked up your phone, you opened the app for JM Bullion or APIMEX or SD Bullion, and what did you see? Did you see a buy button? Did you see inventory available for purchase? Did you see a confirmation screen? No. You saw an error message. You saw a spinning wheel of death. Or in the case of JM Bullion, you saw a polite little notice saying the site was down for scheduled maintenance. Scheduled maintenance on a Friday morning, during the most volatile trading session in precious metals history. Do you really believe their IT department decided that right now, in the middle of a market crash, was the perfect time to update the server software? Please, I have a bridge in Brooklyn to sell you. This was not maintenance. This was a circuit breaker. The dealers pulled the plug. And I'm going to tell you exactly why. Because they knew that if they left the site operational at $90 silver, they would be wiped out. They knew the demand would be so overwhelming, the tsunami of buy orders so massive, that they would sell every ounce of inventory in their warehouses in 10 minutes. And here's the kicker. They couldn't hedge it. With the price crashing and the market in chaos, they couldn't buy paper contracts to offset their physical sales. They couldn't protect themselves, so they just shut the doors. They turned off the lights and hid under the desk. And it wasn't just the US dealers. The conspiracy goes global. Reports coming out of London indicate that the LBMA, the London Bullion Market Association, their electronic matching systems went offline due to technical difficulties right as the smash began. This effectively locked out Asian buyers. It locked out the Chinese arbitrageurs who were ready to buy everything in sight. By killing the connection, the Western banks ensured there was no bid to stop the crash. They created a vacuum. They cleared the order book so the price could free fall to 90 without hitting any resistance. This is the definition of a rigged market. When the price goes up, they hike margins to stop you from buying. When the price goes down, they turn off the website to stop you from buying. Heads they win, tails you lose. But you only lose if you play their game. You only lose if you panic. Because the entire purpose of this window dressing, the entire goal of smashing the price to 90 and locking the doors, is to make you do one specific thing. They want you to sell. They're hoping that you, the retail holder with physical silver in your safe, will look at that $90 price, feel the pain in your stomach, and rush to your local coin shop to dump your stack before it goes lower. They're desperate for your physical metal. They smash the paper price to shake the physical tree. They're praying you have weak hands. But there's a flaw in their plan. There's a variable they didn't account for. They thought they could shut off the liquidity. They thought they could clog the plumbing so nobody could buy the dip. But they forgot about the whales. They forgot about private capital that doesn't need a website to buy silver. They forgot about the men who buy entire lots from refineries. And while JM Bullion was down for maintenance, a white knight entered the market. A man with $200 million in capital just stepped into the breach to clear the blockage the banks created. If you want to understand how this market really works, subscribe now. Because what I'm about to show you is how one private investor just put a floor under this entire market. We need to talk about the junk silver crisis. Because while the websites were down and the paper price was crashing, a silent emergency was unfolding in the back rooms of every coin shop in America. It was a crisis involving constitutional silver. We're talking about pre-1965 dimes, quarters, and half dollars, the 90% silver coins that most people call junk silver. Usually, this is the lifeblood of the retail precious metals market. It's the most liquid, most recognizable form of silver in the world. But in the last 48 hours, it became a toxic asset. Not because it isn't valuable, but because the refiners stopped buying it. Here's what happened. The major refineries, the companies that melt down scrap and turn it into shiny new 1,000-ounce bars for the COMEX, are running at 110% capacity. They're overwhelmed. They have so much industrial demand and so much demand for pure bullion that they stopped accepting the dirty stuff. They told wholesalers, don't send us bags of dimes. It takes too long to refine. It slows down our furnaces. We only want pure industrial scrap. This created a massive bottleneck. Local coin shops were sitting on mountains of 90% silver that they'd bought from the public. They tried to sell it to big wholesalers to free up cash. The wholesalers said, sorry, we can't buy it because the refiners won't take it. So the local shops ran out of cash. And when the local shops run out of cash, the bid disappears. If you walked into a shop yesterday trying to sell your silver, the guy behind the counter might have actually turned you away. Not because he didn't want the silver, because he was literally illiquid. The plumbing was backed up. The toilet was clogged. This was the moment the banks were waiting for. This was the liquidity trap working perfectly. Price crashing, websites down, local shops broke, panic everywhere. But then the phone rang. And on the other end of the line was not a bank, not a hedge fund. It was a private investor named David Bateman. Now, you might not know his name, but in the world of physical precious metals, he just became a legend. He looked at this clogged market, this market where dealers were drowning in 90% silver they couldn't sell, and he didn't see a problem. He saw the opportunity of a lifetime. He stepped in with a $200 million offer. He told wholesalers, I'll buy your junk silver, all of it, at fair prices. You clear your inventory, I get the metal, everyone wins. And just like that, the blockage cleared. The cash started flowing again. The local coin shops could breathe. The market stabilized not because of the Fed, not because of JP Morgan, but because one private whale understood what was actually happening. And while retail investors were panicking, he was accumulating. But you have to ask yourself, who's on the other side of this trade? If the price crashed to 90, somebody had to be selling, but more importantly, somebody had to be buying. Do you think Chinese buyers are scared of the drop? No, they're laughing. They're looking at the screen saying, the Americans are crazy. They're selling us their strategic reserves at a discount. They're backing up cargo ships. This crash is the greatest gift Beijing could have asked for. It allows them to restock their empty vaults at bargain prices, paid for by the panic of weak-handed Western investors. But here's the twist. Usually when a market crashes like this, speculators pile in on the short side. Hedge funds smell blood and short the market to zero. But today, the data shows something very strange. The smart money is not shorting. The hedge funds are looking at the $132 price in China, and they're terrified to bet against it. They know that if the arbitrage vacuum sucks hard enough, the New York price will explode violently to close the gap. So despite the crash, short interest is practically zero. Subscribe if you want to see the data the media won't show you, because what I'm about to reveal next exposes exactly who's responsible for this crash. We need to talk about the short trap, because this leads us to the most bizarre statistic of the day. Usually, when you see a market crash by 25% in a single morning, it triggers a feeding frenzy. The sharks smell blood. Hedge funds, algorithms, momentum traders, they all pile in on the short side. They borrow shares, sell them, and try to ride the price down to zero. And usually when this happens, the cost to borrow shares, the borrow fee, skyrockets because everyone's fighting for the same shares to short. But today, we're looking at the internal data for SLV, the biggest silver ETF in the world, and it's telling us something that shouldn't be happening during a crash. It's telling us the smart money is completely absent from the sell-off. We checked the prime brokerage data. As of this afternoon, the fee to borrow shares of SLV is sitting at 0.53%. Basically free. Rock bottom. And the number of shares available to borrow? Over 10 million shares sitting there collecting dust. Nobody wants them. Nobody's borrowing them. Nobody is shorting. Do you understand how insane that is? The price just dropped $30. A historic collapse. And yet, speculators are refusing to bet against the metal. Why? Because they're not stupid. Hedge fund managers are looking at the same global map we're looking at. They see the $132 price in China. They see the $118 price in Mumbai. And they see the $90 price in New York. And they know that shorting silver at $90 right now is like standing in front of a freight train holding up a piece of paper that says, stop. The freight train is physical demand from the east. And if you stand in front of it, you don't get rich. You get run over. This tells us exactly who's responsible for the crash. It's not the market. It's not speculators. It's a small handful of bullion banks. Likely just 2 or 3 entities furiously dumping their own proprietary positions to drive the price down. They're the only ones selling. They're naked shorting, selling contracts they don't have because they're desperate to cap the price to save their balance sheets. But they're alone in the trenches. The cavalry isn't coming. The rest of the financial world is standing on the sidelines eating popcorn, watching the banks commit suicide. Because the smart money knows this $90 price is a coiled spring. They know the moment the bank stops selling, the arbitrage bots will wake up. The moment the pressure lifts, the price is going to snap back to 118 or 132 in the blink of an eye. And if you're short when that happens, you're dead. So this crash is artificial. It's a painted tape designed to scare you, the retail investor, out of your position. They want you to look at the chart, see the red line, and panic. They want you to sell your real shares so they can buy them back to cover their naked shorts. But institutional players aren't falling for it. They see the 10 million available shares to borrow, and they're saying, no thanks, I'm not touching that. It's electrified. And here's the ultimate irony. Even the banks themselves, the very institutions likely behind the smash, are quietly admitting the game is over. They're publicly smashing the price to 90. But privately, their own strategists are putting out price targets that would make a gold bug blush. Subscribe if you want analysis that tracks what banks do, not what they say, because the contradiction I'm about to show you is total institutional schizophrenia. If you want to know what the banks really think, not what they're trading, but what they're planning for, you have to look at what they're telling their high net worth clients behind closed doors. Because there's a massive wall between the trading desk and the research desk. The trading desk is paid to make money today. They're paid to smash prices, run stops, and fleece retail investors. But the research desk, they're paid to be right eventually. And right now, the biggest bank in the world, JP Morgan, is suffering from severe split personality disorder. On one hand, we see gold being slammed down in a naked short attack that bears all the fingerprints of bullion bank intervention. But on the other hand, at the exact same time, a research note just hit Bloomberg terminals from JP Morgan's lead global strategist, Nikolaos Panagiotis. This man is not a YouTuber. He's not a conspiracy theorist selling canned beans. He's the voice of the establishment. And what's his forecast? Is he calling for gold to crash? Is he saying the bubble popped? No, he's calling for gold to surge toward $8,500 per ounce. Let me repeat that. The screen says $5,200. The bank says $8,500. That's an upside of 63% from current levels. And why is he bullish? Not because of war, not because of supply shortage, because of a single structural shift in global capital markets. Allocation. Panagiotis points out a statistic that should keep every central banker awake at night. The implied allocation of private investors to gold has risen to 4.6%. To a normal person, 4% sounds small. But in the world of global finance where trillions slosh around in bonds and stocks, a move from 1% to 4% is a tsunami. It represents hundreds of billions moving out of paper assets into hard assets. And the bank knows this trend is unstoppable. They know pension funds, sovereign wealth funds, and family offices are losing faith in the debt market. They're scared of inflation. They're scared of currency debasement, and they're moving the dial. So here's the dirty secret. JP Morgan knows the price is going to $8,500. They know the current price of $5,200 is temporary. So why are they smashing it today? Why are they allowing the crash? Because they're accumulating. They're playing a double game. They use the paper market to crush sentiment, to make you feel fear, to make you sell your ETF shares so they can scoop up physical metal at a discount before the inevitable run to 8,000. They're shaking the tree to see if any loose apples fall. And every apple that falls, every contract panic sold by a retail trader today, is being caught by the very institutions predicting the moonshot. It's the classic Wyckoff spring, a terminal shakeout. They drive the price below support to trigger stop losses, flush out weak hands, and generate the liquidity they need to build their own long positions. They're not shorting because they believe gold is worthless. They're shorting to buy time. They're shorting to keep the price down while they load the boat. Because if they let the price gap up to $5,500 today to match London, they'd have to pay more for their own inventory. They're suppressing the price to act as buyer of last resort. So when you see that forecast, 8,500, realize this is the bank's true target. That's where they expect the train to stop. The crash to 5,200 is just a pit stop to refuel. And if you get off the train now, if you let them scare you out of your seat, you're going to be standing on the platform watching the wealth of a generation drive away without you. If you're still watching, subscribe now. Because what I'm about to show you next is the 3-reality system that proves the New York price is a complete hallucination. Here's the verdict. We just walked through the crime scene of the century. We looked at the fingerprints, we examined the weapon, and we identified the victim. The victim is the price discovery mechanism of the United States. It's been bludgeoned to death by a desperate, coordinated attack designed to paint a false reality. We're now living in a decoupled world, a world where the laws of arbitrage have been suspended, where geography determines your wealth. You have 3 choices today, 3 realities to choose from. Reality number 1, the New York price. This is $90 silver. This is $5,200 gold. This is the fake reality. It's a price set by paper contracts, manipulated by high-frequency algorithms, suppressed by banks terrified of the dollar's collapse. It's a price where you cannot get delivery in volume. It's a mirage. Reality number 2, the world price. This is the London and Mumbai price. $118 silver, $5,500 gold. This is fair value. It's the price where physical metal actually changes hands between rational actors. It represents true global consensus before manipulation kicks in. Reality number 3, the China price. $132 silver, $5,600 gold. This is the hard floor. This is the price of desperation. This is what happens when you have 1 billion people and 0 inventory. This is the price that acts as a black hole sucking every ounce of metal out of the West. The tragedy of today is millions of Western investors are looking at reality number 1 and making decisions based on it. They're seeing the $30 drop in New York and selling. They're panicking. And who's buying their metal? Reality number 3 is buying it. Every time an American investor sells a share of SLV or a physical bar because they're scared of the price drop, a state-backed Chinese entity is buying that ounce at a discount and shipping it to Shanghai. You're not just losing money. You're transferring generational wealth to the East. You're selling your insurance policy to the very people betting your house burns down. And you're doing it for $24 less than it's worth. The spread, this $300 gap in gold and $40 gap in silver, is the first crack in the dam. It signals the LBMA and COMEX are losing control. They can smash the paper price, but they cannot smash physical demand. If they keep the price at 90, the vaults will empty even faster. Low prices cure low prices by destroying supply. By making silver cheap in New York, they're guaranteeing there will be no silver left in New York by next month. So this is my final message. Do not let a red candle in the New York session shake you out of a green reality in the rest of the world. Do not be the patsy at the poker table. If JP Morgan thinks gold is going to 8,500, why would you sell at 5,200? If the Chinese government is paying 132 for silver, why would you sell at 90? Use the manipulation to your advantage. If the banks want to put silver on sale, if they want to subsidize your purchase by smashing the price down, take their subsidized metal, because this window won't stay open forever. Eventually, the arbitrage bots will turn back on. Eventually, the metal will run out. And when that happens, the three prices will merge. And they won't merge at 90. They'll merge at 132, and then they'll go higher. Mark from GoFinance. The game is rigged. The spread is real. Don't sell to China. Subscribe if you want analysis that exposes the manipulation before it destroys your wealth.